Well, the Reserve Bank pulled the trigger on another rate cut just over a week ago, and while your first instinct may be to take advantage of the reduction, you might want to think again. Some experts say if you have the means to do so, ignoring the drop in rates could actually save you thousands on your mortgage, and it's a strategy worth considering. For more, Sally Tyndall from Canstar joins us now. Great to have you with us again, Sal. So your advice is to ignore the rate cut if you can and keep paying the same amount.
Okay, yeah, absolutely, because the last 3 years have been incredibly gruelling. Interest rates have been going up, cost of living going up, but most families, the vast majority of families have managed to keep it together. It hasn't been pretty. In some cases, it's been pretty ugly. But what if you kept going? What if you kept your monthly mortgage repayments exactly the same? The bank automatically lowers your interest rate, but you keep your monthly mortgage repayments the same, then that little bit of extra that you were paying in higher interest rate charges, that then goes back into your mortgage as an extra repayment, and it can have an astounding effect on your mortgage. Look at the numbers here on the screen. $600,000 loan. If you kept your monthly repayments exactly the same as what they were in January of this year, you would be paying $272 extra into your mortgage after this last rate cut. But if you keep that up for the life of your loan, then you could save $76,000. $76,000. It's worth saying 3 times, $76,000, and kick your mortgage to the curb 3 years and 3 months early.
You just need to find that 272, make sure you've got it. How do you do it? Because most people are on variable rates and they'll naturally just go down if you don't do anything. Do you have to call your bank and say, hey, that last rate or that last payment I was on, can I keep that going?
Yeah, in some cases you do, but it will vary lender to lender. So understand exactly what your bank does. Westpac, Macquarie, they're 2 of the 5 biggest banks. They will automatically drop your minimum monthly repayments. You will have to pick up the phone and say, hey, I actually want to pay a little bit more. But CBA, ANZ, NAB, they all actually keep your monthly repayments the same unless you call them. So I do believe there's a lot of households across the country that are actually making higher repayments and they might not even realise.
Yeah, that's really interesting too. Is there a better way to use the money potentially? I guess that's a really open question, but what if you take that, say, 272 that you were saying and put it in a high earning account?
Yeah, it's a really good question, actually, because this strategy is not for everyone. You've got to think, does it apply to my financial goals? It probably isn't going to work for someone with, debts to pay that have, struggling to pay the electricity bill. Those people need that money into their account at the moment. Investors, they might actually want to, keep it into an offset account rather than as extra repayment. So I understand the machinations behind that. But, compared to a savings account, well, if your priority is getting rid of that mortgage, then, putting it into the mortgage as an extra repayment or in the offset account typically is better than, say, a savings account because the rates are slightly higher, but also any interest that you earn on a savings account, that gets taxed. So think about it carefully. Have a chat to your accountant.
Yeah, the extra 3 years of freedom not attached to that mortgage sounds pretty good. Thanks, Sal. Here's Nat.